Private equity deals have increased sixfold in the past year, led by two familiar names, Carlyle and Apollo. To give you the kind of insight you won't get anywhere else, we take you right now to our deal desk. Actually, our deal desk has come to us. Iyan Adewuya is with us now. He is a Bloomberg senior analyst. Cristina Alesci is a Bloomberg News private equity reporter. Iyan and Cristina, always good to see you both. So Carlyle versus Apollo, let's put them in the boxing ring. Who's winning? Cristina, we'll start with you.
Carlisle is definitely winning, but they're winning over everyone. They're showing up to auctions early. They're cutting bigger equity checks. In the NBTY deal, which was the nutritional supplement company, they make
vitamins, right?
Exactly, Nature's Bounty, MedRx, kind of protein shake maker. In that specific deal, they showed up to the auction and they said, okay, a week early and with a bigger equity check. So in these deals, it's financed with equity and debt. So they basically took on about $1.4 billion of equity on their own. So it was bigger than any other sponsor was willing to do.
So 23 deals, $8 billion for Carlyle so far this year. And is private equity back?
Well, it's the billion-dollar question, or whatever billions of dollars in dry powder they have. You can look at it from two perspectives. The private equity deal, which I cheesily call the mini-me deal, between 500 to $1 billion to $2 billion, that is back, where you're looking at assets or portfolio companies that have strong cash flows and things of that nature. You can do those deals. If you try to extend out of that range and do a $5 to $10 billion deal, like they tried to do with Fidelity National, you find that your banker may not be your best friend in that kind of situation because they're not ready to finance that.
Let's look at the behemoth, though, because you just pointed out you have the mini-me deals, but then today we have this Tompkins CPP Onyx deal. This is the biggest one of the year. Does this show that there's room for some bigger ones to come back too?
Yeah, I mean, this definitely shows a little bit of bandwidth on the private equity side of things. But again, this is a deal, as Iyan said, with steady. This is a company with steady cash flow. It's sort of nothing sexy or adventurous, shall we say. It's sort of like sticking to their knitting. Even this deal for the medical supply company that Goldman and CD&R announced today, or that we actually broke today. That deal, again, it's sort of sticking to the knitting. It's a distribution company. It has steady cash flows. It could be leveraged. So these are the deals that we're seeing being financed.
CD&R, Iyan, where do you see them fitting in? If you had to stack them, I guess, as we said, Carlyle is sort of winning this big boxing match between Carlyle and Apollo. What about CD&R? I mean, where do they fit in? What kind of activity are they seeing?
I mean, they're doing pretty well. They bought VWR for about $1.6 billion, sold it for about $3 billion to another private equity firm. What's interesting about that deal Cristina was talking about is that it's typical to me in three ways. A, it's a secondary buyout, one private equity firm dealing with another private equity firm from the same old portfolio company.
And banks like to finance those deals.
Absolutely.
It's more comfortable for them, I imagine.
Yeah, because they know the players. They know if one smart guy is willing to buy it off of another smart guy.
Absolutely.
Two smart guys can't be wrong.
Yeah. And so, and then you see those who are financing the deal, probably Jefferies and GSO Capital. So you're getting some money from a traditional bank lender and a non-traditional type of mezzanine financing from a hedge fund. So these things are the types of deals you're going to be seeing more going forward.
But there is a noticeable difference between those private equity firms that are doing the deals and those that are not. Like Blackstone, for example, they've been noticeably out of the game for the year, right? Wouldn't you say?
Yeah, absolutely.
I mean, they've just not. They've been participating in auctions, looking at stuff, but not really winning them. So the question then becomes, how much time are you going to spend looking at the deals? How many people are you going to put looking at these deals and picking them apart, and how many are you going to actually get done?
Certainly don't want to be known as a tire kicker in this industry.